Hello, everyone. This is Sebastian McMahon from IA Financial Group. It's allergy season, so my voice is a bit harsher than usual. So let's hope I can keep going through this whole presentation, but I'll be very happy to cover the week ending May 20th, 2022. So let's start with a look at this week's markets at the close on Thursday. So very interesting behavior from the stock market, from markets this week. So the bond market rallied this week on negative economic news. So the connection between bonds and stocks, so the inverse relationship is starting to hold again. So it's starting to make sense. So that's good news. So if anyone out there was thinking that, well, bonds are so negative this year, I don't want any bonds in my portfolio anymore. Well, that would have been a mistake, because maybe just some historical perspective, since 1977, the only 2 years when you had both negative returns in global equities and global bonds were 2015 and 2018. So in the last 45 years, it happened only twice. 2022, if the trend remains, that will be the third year in 46 years now that we have good data to cover that. So the relationship usually is that even on a typical year, you have positive returns from both bonds and equities, but the rest of the years typically diversifies away. So either you have positive on bonds, negative equities, or the reverse, but negative for both, that's very rare. And now we're starting to see the relationship hold again. So that's a good news. And this week also, we had a very strong negative week on the S&P 500, but positive on the TSX, positive on EFI in Canadian dollars, and positive on emerging markets. So the composition of the TSX and emerging market indices are helping, especially in Canada, with energy and materials being an important part. But the US stock market was much more expensive on a PE basis, price to cash flow basis, than other markets. And now that means that it's correcting more. And we're starting to see also the negative story in the US economy unfold, and it's starting to hurt earnings expectations and weighing on the market. So more on that in a second. But in our funds, we remain underweight equities. We have a strong underweight equities on a strong underweight on US equities. We have a small overweight on Canadian equities, so the net is negative, but we play the spread. So we think the TSX will continue to do better than the S&P 500. And now the gap in Canadian dollars between the two is at about 12.5% right now. So that's a good spread between Canada and the US. Up on oil, up on the Canadian dollar, up on the euro, and up on the price of gold. So US centric this week. So now, maybe the wordplay of the week, zero COVID brings China back to square one. So if you look at the data points here, industrial production on the left, retail sales on the right in China, so year over year. So as you can see, the damage is being done by the new COVID zero policy. Of course, Omicron is less viral, but it's more contagious. So they want to have zero cases, so they need to shut down a good part of the country. So industrial output is in even worse shape than in early 2020, and retail sales are contracting pretty much as in early 2020. So if China slows down, that's not a positive for global growth. Now we're hearing news this week that they're looking to get the credit cycle going again to stimulate the mortgage market. So that's all good. That's going to create some growth there. But the relationship that we have, that we've estimated, is that it takes a good 9 months for any measure in China to have an impact on the global economy. So that's going to help at some point turn things around. But before we feel it in global economic data, that's more of an early 2023 story. So still have a few months to go before we get there. Maybe looking at the inflation now in Canada, we talk about that a whole lot. So 6.8% year over year in April. Is that the peak? It's likely the peak. We're in the peaking process, let's say. So is it next month? But we're in the peaking process. Interestingly, this is for April. In May, so the data that we'll have in a month will include used car prices. Maybe that's going to be playing with the level here. So let's see next month where we end up. But now what's more concerning is not the fact that it's a 30-year high, because every single month, it seems in 2022, I talk about the 30-year high in inflation. It's the breadth that's getting concerning. So price of gasoline, price of food, price of shelter, things that you can't really diversify away in your consumption. So you can't substitute food transportation and shelter for anything you need to pay for these. If they cost more, that means that at the end of the day, you have less money in your pocket to buy anything else. And that's how recessions are formed, when you buy less amount, the quantity of stuff, not the dollars that you pay, but the quantity of things, goods and services that you buy. When it goes down, that's real GDP contracting, and you have the possibilities of a recession. So this is true in Canada. This is even more true in the US, and we're seeing some worrying data downside. The Canadian economy right now, at least it has terms of trades are very favorable, meaning that the price of commodities are high. So what we export went up in value, so that helps. We have a few tailwinds. Labor market is doing pretty good, but still we won't avoid the headwinds that the world is facing right now. And talking about that, if we move to the link between the economy and the markets. So the Federal Reserve, so Mr. Powell, so the central bank of the US, Mr. Powell, the chairman, said that the Fed has resolved to bring US inflation down. So talking really hawkishly, saying that we will do whatever we can to tackle inflation. Now, the question is monetary policy the right tool to fight this inflation? So inflation from food and from gasoline prices. It's not true that central banks can do much about that. It's not like we have a speculative bubble because money is easy and there's some overspending, and if you tighten monetary policy, you're gonna hold everything back. That works in this kind of inflation if it's demand driven, but here it's more supply driven, and we have nothing that we can do in central banks, but it's their mandate to tackle inflation, so they'll still tighten anyway. So it's kind of a conundrum here that's going to be uh, important for the economic story in here. Maybe two stories on the left. You have a quote from Bloomberg about the JP Morgan saying that refiners are very late in the season now. They're behind the schedule to produce enough gasoline for the summer, because it's in the summer that we use the most gasoline because of vacations and transportation. We move around, and that means probably $6 a gallon in the US during the summer. Probably that translates to $2.50, $3 a liter in Canada, somewhere like that. So expect more inflation even from gasoline. And in May, we've seen that. And on the right, this is the Bank of England's governor talking about, and I love the fact that he says he's going to sound apocalyptic. So he's not trying to play the crowd here. I mean, he's just very serious that food inflation will be something that continues. Ukraine, Russia, India, big producers of grain, they all have their issues. India is closing the borders on exports. And we see prices rising around the world, should continue. So nothing we can do about that either. So this leads to some earnings calls that we've had, earnings transcripts this week from Walmart, Target, Lowe's, Home Depot, citing that one, inflation is starting to bite into their profit margin because it costs more to produce, so they have to pay higher costs for what they sell, so less earnings. They're seeing less demand for discretionary goods, so that's the story I was telling. If you have to spend more at the grocery store, more at the pump, more on shelter to buy the same thing, then you have less money to buy anything else. So there's less demand in the pipeline for other goods that are sold at these stores. So that's a very important issue. Maybe they have too much inventory right now. That's one thing they said. Maybe they hired too many people. So all of these things led the stock market on a second decline this week. Probably it's a second leg. So it's not so much about rising rates. Now it's more about the damage to the economy. Earning expectations are probably too elevated. They'll need to come down, and there's fewer good reasons to hold stocks, let's say. So that's the second leg that we could see. We're on the verge of a bear market here, but minus 18.7% as of the close of yesterday on Thursday. We're just on the verge. So let's see if we hit it soon, or if it takes a few more weeks. We think we go there. And the average bear market is minus 29%. Peak to trough, we're at minus 18.7 as of the close on Thursday. The median bear market is minus 24%. So there's still room for downside here. So we're not adding risk to our portfolios. We still even remove some risk this week because we saw the beginning and a new second leg, a new story that could take the stock market lower. So we remove some risks, and we're not in the mood to add or to time the bottom here. But I want to tackle this because I know it's very important to everyone listening. So here you have two things. So, and I know that you like the one on the left because when I post it, usually that's when I get the most email after that. So these are not our indicators. Those are indicators from on the left, Bank of America. On the right, you have Strategas. And we look at dozens of indicators and we try to aggregate them and make our mind based on what's there, because it's never 100% sell or 100% buy. It's always somewhere in the middle, but you want to see a good reason to buy again. So on the left, you have the Bank of America indicator, which is a contrarian one. Right now, it shows that there's extreme fear in the market. So for them, it's a buy opportunity. So there's extreme fear, but it's time to buy. If you have a short-term horizon, you want to bet, you can play that if you want. If you have a 5-year time horizon, of course, right now, buying 5 years is going to make a lot of sense. But if you want to time the market, try and time the bottom, I think you need more than just one indicator. But at least this one is green. So if in your personal account you want to play, you go ahead, but we're not adding, we're still removing. On the right, Strategist, it's a list of a checklist, and those are the signposts for a durable rally. So our job is to protect capital and to make sure that when we invest it, when we put money at work, that it's in a durable rally. We're not betting coming in a week, coming out after that. That's not what we do. We want to see durable rallies. And here, according to Strategas, on the list of about 10 items here, only 2 have a check. These are all back tested through time, so this is their list. So tells us that, yeah, maybe fear is getting extreme, but we haven't seen enough damage to say that, well, this is a durable base here. What we do very much like to look at right now is this one, credit spreads. So for high yield bonds. So, the businesses, the companies that are listed on the S&P 500, they also have debt. So S&P 500 is equity, and they also have debt. They borrow money, and some of them are good quality, some are lower quality, and this is the lower quality bunch here. So high yield is not all the businesses that are in the high yield index are also on the S&P 500, but they're American corporations. And right now the spreads, so the higher the spread, that means that the higher people will ask to have the higher interest rate, people will ask to invest in the debt of these companies. So if you need a higher interest rate, that means you have less trust. So when spreads go higher, that means stress, that means less demand. So that's a negative. And when spreads are tight, that means everyone want it. And there's a lot of demand. So spreads are lower. So when spreads widen, that means that there's some risk. And look at the spreads right now on the right of the chart. We're not even at 2018 levels when there was a scare. But I like to look at the 2015-16 period because it was a mid-cycle slowdown like we're having now. China was going through a rough patch like we're seeing now. And look at how the spreads widen, and even they widened, they contracted, and they widened again. So, I mean, what you want to see a peak in this before you say, all right, coast is clear, let's start to put more risk in the portfolio and buy more stocks. So we're looking at this one. An interesting thing for us this week was when we had a rebound of the stock market early in the week. The credit spreads did not tighten, even they stayed flat or even widened a little bit more. So for us, that was a confirmation that it's not time to plunge again. So took more time here to flesh things out. I want to make everyone understand how we work, to give you our views at the end of the day. I mean, it's the market is the same for everyone. So if you want to take your shot, take your shots. But right now we're still in the midst of being careful, even removing some risk, making sure that we're in a better position for the eventual up leg that will happen at some time. So what to watch next week? Canada retail sales in the US, GDP growth for Q1. Negative surprise we had the last time for Q1. Now that's going to be the second reading, so it should still remain negative. We'll have data on the consumer, personal income, spending, and consumer confidence. So that wraps it up. ia.ca/economy. Economy and Finance 101. There's new material there posted recently. You can follow me on Twitter and on LinkedIn. And if you want a PDF copy of this presentation, go to LinkedIn, connect with me, or just search my name. I'll post it every single Friday mornings before the video is available. I post the PDF there. So that always a pleasure to serve you. And I'll be back again next week with another edition of the Weekly Review.